Good afternoon, everybody. Welcome to the Roma webinar. I'm Scott Marshall. I'm the founder and the managing director at Roma Finance. And today I'm joined by...
Well, I'll introduce myself. I'm Michael Allison. I'm the commercial director at Roma Finance.
It's a pleasure to have you here. And I think that there's a number of things that we want to touch on today and to cover. And I think that we always say as a business that volatility creates opportunity. And what we want to do really is talk about what that actually means. The volatile environment that we are in at the moment, I think no one can disagree that it's definitely a volatile environment, whether you're talking about the UK, whether you are talking about geopolitics, whether you're talking about anything to do with even down to the property market. It is definitely a volatile climate. And where does the UK sit at the moment? Where do property investors sit? Interest rates didn't change today. I think we said that they wouldn't change. Why didn't they change, despite the fact that there's clearly some stress within the UK economy?
Yeah, and I think we're obviously looking at Roma because you've got you're well versed in the economics, I guess, the geopolitical as well, and how that affects us as a business, because we're always conversing with different leads, and we take a lot for that. And I think today what we're hoping is to share some of that.
Yes.
We're going to start at such a large level and bring our way all the way back down to what it means for you as the property investor, or for the people who are working with those property investors. Some of the opportunities we're seeing as well. So we like to share some of the good success stories, because it's not all stress and negativity. There are some opportunities.
Yeah, we're going to touch on the green shoots that exist, and actually why now is a great time to buy. And we'll come on to that. So to park that thought for a moment, as we kind of work our way from the high level right down to what it means for the ordinary person on the street. Okay, so Michael, let's first of all talk about geopolitics. Okay, and let's go back to, in fact, let's not start with geopolitics. Let's start with the budget from November last year.
Okay.
Disaster for SMEs. Fantastic for local authorities.
Yeah.
Disaster for SMEs. Growth.
An overnight disaster as well.
Overnight disaster.
With the stamp duty piece, etc., that we saw in that moment in time.
Indeed. And if we look at actually what it means for businesses, the only way to get growth is really through consumer sentiment. And if we look at what the government did with national insurance, which I think is the biggest thing, their whole mantra was, we want to take from the people who can afford it the most, in order to fill the notional hole that was in the public finances. Yeah. So they increased, if we just recap, they increased the national insurance contribution from employers from 13.8% to 15%. And they also reduced the threshold where payments are made, so that many more people were captured.
Yeah.
And if we look at the industries that were most impacted by that, reducing the threshold in particular, and obviously the living wage went up as well, also making things worse. Those sectors were leisure, hospitality, retail, tourism. Okay, and those are the sectors where some of the lowest paid people are employed, and therefore those are the places that can afford it the least. They were already marginal because of the impact of COVID. They were already marginal, and so those businesses that were marginal all of a sudden become, makes it a big cost and bottom line. If I think about Roma, and obviously we're not in that sector, but think about Roma, it's a six-figure impact from our perspective. We've already seen job losses within some of the major retailers, Morrison's, Asda, Sainsbury's, Tesco's. They've let people go, and that's because they're trying to grapple with the impact of national insurance on their business. Someone's got to pay for it. They can't increase prices, all the time to offset that increase in their cost base.
We were talking to somebody the other day, if you remember, and he came up with a really key statement, which was, it'll either have to hit the bottom line or go on the front line.
Yes.
So the person who ends up paying, if you think of builders merchants as an example, they've been hit with all these pressures. So that goes on. So that affects our target market as well. So you can see it's not just a small slice of society. It goes straight across the spectrum.
Right. So what actually then happens is, businesses then feed that into their pay bargaining with their people. which means that the people that were due to get pay rises and being sensitive, and firms that were going to recruit, they all of a sudden they don't give the pay rises that the people deserve, and they also don't invest in people in a way that they would have done ordinarily had the cost not have been more realistic. And the third thing, of course, is the Employment Rights Bill that's going through Parliament makes it even more difficult. If you've got a good person, you'll always promote them through your business, but sometimes there's you have more challenging people in an organisation, and you have to be able to, as a business, deal with those people, because it's very much, and when you're an employer, you're looking for people that have got the hunger and the will to do well. You'll always take will over skill. You can teach skills, but will and attitude, you can't. They're not so easy to teach, are they?
Well, no. Listen, at the end of the day, hard work beats talent when talent doesn't work hard.
And I think that's a great phrase.
Yeah.
Just repeat that one more time.
I've now got to remember it. Hard work beats talent when talent doesn't work hard. So, certainly in times of stress, you talked about we're in a stress position as a nation. In times of stress, it's the hard work, it's the rolling up of the sleeves that get things done. A lot of property developers, if you think about one of the subsets of customers that we work with, the experienced property professional, they're probably plastering houses at midnight with a torch on the head because they've still not done the electricity. That type of hard work, and that's the mantra. And the SME builder and the professional landlords are actually should be the government's best friend to help us get
100%.
fulfill those needs.
But then if we kind of take what's happening within businesses, if we take what's happening within businesses, and we say to ourselves, right, okay, so if you're an employee within a business and you see that the firm is no longer recruiting, in fact, if anything, they're laying people off, number one, so they're not recruiting, laying people off, they're not investing in people, and they didn't give the pay bargains that you were hoping for or expecting, and therefore you feel less secure in your job, what does that do to any spare money that you've got? It makes you not want to spend. It makes you not want to, use your disposable income to go for that meal, to have that holiday, to get that new car, to whatever, to improve your home. Instead, what you do is you batten down the hatchets and you rein in your spending. And so a lot of growth within an economy is driven by consumer sentiment, and we can talk ourselves down because actually people, and the media does an even better job of that, as we all know, but we can talk ourselves down. But what it ultimately means is that people do less, people spend less, and so you end up in like a virtuous circle. And I think that with again, we keep going back to that budget from last year, the government had a fantastic opportunity to drive growth within the UK. We sit outside the EU, and we know at this moment in time that Germany is having its challenges, France is having its challenges, Italy is having its challenges, and there is a fantastic opportunity, particularly because UK businesses, UK PLC, the firms that are listed on the London stock market, they are they're trading at a discount. Our currency has been weak since Brexit, so there is a fantastic opportunity really to position the UK as a great place for overseas firms to come and do business. And maybe we can kind of touch on what that actually means, and talking about the green shoots, if I may, for a second. I'll talk about what is likely to be coming down the track, because whilst economically and domestically, from an economic perspective, some of the decisions that were made back in November have not been great for British business. Actually, because it's not been great for British business, and because British business has really suffered since Brexit, and sterling has really suffered, what that means is that British businesses or listed businesses, British businesses, the UK stock market, and also British assets right now are cheap. And therefore, there is a ton of money that is now looking at the UK. They don't see the domestic stress that we see from a micro budget from November. What they see is that for the first time in 3 or 4 years, maybe even 5 years, there is political stability within the UK. Like it or not, there is political stability, certainly at the moment. The EU, certain countries in the EU are having their challenges, and they do not impact on the UK so much because we're now outside of the EU, and because assets are cheap because of the weak currency, now is a good time to invest. Okay, and so if I can just say one more thing, which is that if we kind of look at what's going on in the States at the moment with the kind of the tariff wars, then you can see that actually, and you can see that with volatility within the stock market, the S&P and the Dow Jones, the volatility within the US generally economically means that the dollar is likely to become weaker, which means that sterling is likely to become stronger, which means that actually if you invest money now within the UK, just naturally, if you don't do anything at all, they'll be worth more money. Okay, so there's a ton of overseas money from the Middle East, from the States, from the Far East that is ready and waiting to come to the UK because right now we're cheap. But and this is my prediction, that over the next 12 to 18 months, because of the political stability, we will see that there is a huge amount of interest in buying UK businesses and UK assets.
That's your job creation. That's your opportunity to do more. I think one thing just on the economy. I know we talked about the global sphere there. As a nation, as a country, as employees, as employers, as investors, we're coming a bit used to a few bumps in the road, aren't we? If you cast your mind all the way back, it felt like we lived in a very stable world. Then the Brexit vote happened, and since then we've gone from Brexit to pandemics to war to cost of living, and it just Trustonomics, everything just seems to. But we're getting a lot of steel, and there has been some real good success stories despite all that negative background. There's so many success stories that we work with. Our business itself has been a real success story during that period of time. So just because something's popular in the news today or is a headline today doesn't mean that it should affect the opportunities going forward.
I think you raise a really, really good point, and that is that the UK generally has performed much better than people were expecting from all these bumps in the road. And if we look back 15, 16 years ago to the global financial crisis, that was caused by banks having no money. And the disciplines that have been introduced into the financial system since, separating the retail banks from the investment banks, and making sure that lenders properly assess a borrower's affordability, which it was done on a self-serve basis, because we both know 20 years ago without the proper checks, stress testing affordability based on the pay rate plus a margin, the fact that the property market itself has done so well, the fact that because banks have separated the toxic from the non-toxic retail side, it's meant that their own balance sheets and capital bases have been much stronger. The average weighted average loan to value across mortgaged properties is below 40%. That's meant that where there has been stress and people have experienced stress, lenders have been able to, because they've had the capital to support borrowers through challenging times. As interest rates have gone up because affordability checks were there, actually, yes, it has been more difficult for people, without shadow of a doubt. But the lenders have known that customers can afford it, and where they couldn't afford things, they've been able to almost like capitalise arrears, extend terms, and work with customers to ensure a positive outcome, which meant that there's not been a flood of properties on the market in distressed states, which has kind of kept the property market stable.
Yeah, you're certainly not seeing terms of mortgage prisoners. That was a popular term from 2009 to 2013, 14.
Yeah.
You're not seeing popular terms like negative equity, again, because of not only the due diligence, but people are a lot more financially savvy than they were pre-pandemic. Everybody is much more aware of their own credit performance, of their own opportunities to invest cash and money. I think we're a lot more financially astute. I think 2008 was obviously a wake-up call.
Yeah.
For a lot of people who may be over-reliant on debt.
Yes.
But we've transitioned through that. So it feels like we feel very, there's a confidence from what you're saying. I think just on the next slide, I think we've actually got a poll that we'd like to know from and thanks everyone for joining us, by the way. We've got straight into it. Thank you for joining us. There is a poll about if you feel confident investing in property in this current economic state, and we'd be delighted to hear from you on that. So we'll see what the results look like through that. I'm not sure how this is where I tap out on technology. So we're seeing that there's a real good sentiment already. Pegging it back. I feel like I'm doing a horse race here. I'm leading it.
Have we got 50p bet on the results?
Never gamble.
Never a lender or borrower be even.
Right. Okay. Yeah, there is that. Right. So I think looking at the results coming through, it does definitely feels like that 70-30 split is round about where you'd expect it to be, because, as I say, Roma ourselves, we've seen a growth in our business during all these speed bumps in the road, which, and I always think back to, it was my job interview when
On the golf course during COVID.
Yeah, when we had to walk around the thing in the middle of COVID, lockdown. We met socially distanced, of course. We walked a golf course with your dog, and you said there was no better time to have a go. Volatility creates opportunity, is what you said, and you sold me the dream of joining Roma, and you said we've got a growth plan. I'm thinking, growth plan? We're in the middle of that. We don't know where we're going to be, and you grabbed hold of that. So absolutely, I think that
if I look back at where we were,
Yeah.
you know, at the time it was obviously a risk.
Yeah.
But the fundamentals were all very strong.
Mm.
So base rate 0.1%, help to buy, furlough scheme, stamp duty holidays, all the fundamentals of supporting a property market were absolutely there. And people were, in most cases, not everyone had a positive experience, but in many cases, people were earning what they were earning, but they didn't have the expenses that they had, and so they built up a massive amount of involuntary savings. And interestingly, if you look at the number of mortgage-free properties now compared to what it was 5 years ago, there's been a 20% increase in unmortgaged properties.
Mm.
Okay, and so a 20% reduction in mortgage properties. And I've got the stats that I can show you. And in addition to that, involuntary savings went from 90 billion to 300 billion.
Mm.
So again, one of the reasons why people have been able to get through the challenges that we face as a result of the cost of living crisis, inflation, etc., was because there's so much involuntary savings that have been put aside, and because people have nothing else to spend their money on at that time. And so, you know, it is definitely the media do a fantastic job of talking everything down, but the reality is, just putting the budget to one side for a moment, it is, given the fact that the UK is an attractive place now for overseas investors to put money into, now is a fantastic time to buy, because everything it is at a discounted price, and where you see inflation, and obviously we've seen rents go up on rental properties within the buy-to-let space, again partly because of the shortage, and partly because demand led. Asset values inevitably will increase on the back of it. So particularly if sterling gets stronger, which is what I expect it to do, from the very low base that it's at the moment. And one of the things that you also have to remember is that commodities, they're all traded in dollars. And so because they're all traded in dollars, you've also got to look at what's going on in the States. The likelihood is that because of the challenges in the States, the Fed is going to have to drop their base rate pretty quickly in order to keep their economy going. So we'll see that base rates in the UK will have no choice but to follow, to avoid it becoming an inflationary environment.
So what's interesting there is that despite the headlines, it's looking for the green shoots yourself.
Yeah.
And everyone's got their own risk framework, whatever you want to call it. They've all got their own centric to risk. So it's finding what are them green shoots for you as well. I think if we just move to the next slide, I think what would be good for us to start thinking about is if the nation, there are opportunities, what do we think is looking for a good investment? Some of the stuff we're seeing.
So one of the things that I always say is follow the money.
Yeah.
Okay. So where you see that local authorities are spending money in those areas, there is that they are the ones that are the pioneers within those places, and it is likely as a result of local authorities spending money that there's going to be demand for people wanting to live in the areas where local authorities are investing in. And so I always say, follow the money. So it doesn't matter whether it's Darlington, where we were recently, where we saw that the Treasury and Revenue have moved, local authorities spending money on infrastructure, on the town centre, etc. But it's obvious that thousands of people are going to be moving there. They're going to need jobs, they're going to need housing, they're going to need infrastructure, they're going to need etc. etc. So they'll need restaurants, they'll need hairdressers, they'll need barbers, they'll need places to go, they'll need cinema. All that stuff follows. So if you as an investor see local authorities spending money and investing, the government spending money and investing, then if you get in early, then you will get the income and you will also get the capital growth.
Yeah, certainly. Blackpool's been another area that we've seen as well at the back of. So Blackpool is obviously famed for its streets of B&Bs.
The Vegas of the North.
Vegas of the North, and obviously as a resident next to Blackpool, it is the Vegas of the North, just so you know. But the days of people going to B&Bs for a week's holiday in Blackpool have gone. So that really went into a state of decline. But now you've got the Department of Work and Pensions have opened up 800 desks in the new building there, and UCLan Lancashire University are opening a campus there. There's the opportunity to get in at the right time. Morecambe just around the coast, Eden Project 2, which will bring much needed reinvestment in travel and tourism in an old sleepy seaside town. And we've seen some really good investments.
We have seen
that kind of area. And then you've got the other areas across the UK who are continuing to do this piece.
Look at the amount of business we're doing across what we call the Central Belt. Right the way from where from sort of Birmingham all the way east, all the way to Norwich. There's a huge amount of investment in housing, believe it or not, despite the planning constraints that have been. So housing, roads, railways, schools. There is so much investment going on, and the customers that we've been funding, everything that's being built, even in the current climate, it's selling or it's renting.
Yeah, that goes back to the SME house building.
It does.
So if the SME house builder they'll have a smaller unit site. We work with the customer over in Leeds, who has done fantastically well. Only got up to about 34, 40 units, but they've increased in value and size as it continues to go through, and they become a destination point, an aspiration. And they sit lovely within the chain. People move into it, people move down to it, and it creates much needed stock elsewhere. And it goes back to the SME house builder in those areas at the right time, creating new homes. But we see the high street.
But that customer, he's close to his customers. He lives, eats, sleeps, and breathes the project. Going back to what you were saying about hard work and talent, he lives, eats, sleeps, and breathes those properties. He's on site, talking to potential buyers. What kitchen do you want? What do you want here? What the bathroom? He knows his product. Whereas the big house builders, and obviously there will always be a market for the barrel box, always. But our customers, they want to solve their buyers' issues. And they're trying to create products that are going into a liquid market. And I think that's something that's also very important, that when you're a developer, knowing and understanding what it is you are trying to do and the market that you are trying to serve, it's so important. Because take Manchester by way of example. Forgive me if someone lives in Moston, and I don't want to insult anybody, but if you're putting in a Mark Wilkinson kitchen into a terrace house in Moston, you'll never get the value for it. Whereas if you're putting a melamine work surface into an expensive house in Alderley Edge, which is where the footballers live, again, you're never going to float someone's boat. And so knowing your customer and the environment and the market that you are creating a product for is really, really, really important.
No, definitely. And I think as well at the same time, it's, I'm passionate about it. It's the regeneration of the high street, and it's going to take a long time. But when I was a child, in the 80s, the high street with the town centre, local town centre high street was somewhere you go and get your school shoes, you go and get a book, and you might have something to eat. Fast forward to now, 2025, the high street is probably somewhere where you go for something to eat, and you might pick something up from one of the.
It's a leisure experience.
It is. But if you get a leisure experience, you walk down your high street. Next time anyone walks down the local high street, I walk down mine in St Anne. Look above the shops. All that opportunity for commercial, residential, living space to bring the footfall back. And the shops on the high street will slowly evolve. You'll get your artisan bakers, you'll get your different types of things. There's pottery, you can do pottery and have a glass of wine in a shop around. There's loads of unique opportunities, and that's business people having a go, and it becomes a destination point. It's not going to happen overnight. We're never going to get back to the days where the streets are full all the time, but at least we're creating something different.
Interesting. If I think about where I live, which is Altrincham, 15 years ago, it was on its knees. Loads of vacant units, charity shops, empty units. It was really, really struggling. And Altrincham Market was transformed into an eatery. Loads of small local businesses were invited to occupy this derelict market space, which they did, and it became all of a sudden. And it took some time. But now it is heaving. There's loads of eateries that have opened around it. The high street is being regenerated. The local authorities put money into it, and it's growing and it's expanding.
Again, think about it: the investment from the council in the tram network. So all of a sudden, it became accessible for people along that way to go to Altrincham. So it's following back to what we were saying before. Following the money and the investment. Getting in there 10 years ago in Altrincham would have been fantastic.
100%. And if we look at actually what's happened there, because it's become so much of a, it's been regenerated. There's a new hospital. There's doctors' surgeries. There's pharmacies. There's supermarkets. There's eateries. There's obviously the food market. There's so much. There's a library. There's so much going on that it then draws people in, and people want to live there. And because the connectivity with the tram network and the buses and what have you, actually, it means that people want to live there. So you've got the footfall, and it's all from the vision of transforming derelict property into an eating place. And it's taken a few years, but it is absolutely booming.
Interestingly, let's call it 15 years. In that 15-year timeline is a pandemic, is a Brexit, is a Trussonomics, is a Ukraine war. There is the cost of living crisis. All of that, the fuel, what all happened, but it's still thriving. Some businesses didn't quite make it, and that's
it's normal. That's capitalism.
But at the same time, it's in a stronger position now than it was 5 years ago, 10 years ago, 15 years ago. And it's investment. It's not always about the quick buck. It's about knowing when to buy and when to sell.
Well, that's what business is about. Business, and it doesn't matter whether you are a property trader or you're making widgets or you're selling iPhones. Every business is about being able to buy well. And going back to what we're saying right at the very start, which is volatility creates opportunity. What happens is when there is a more volatile environment and things are being talked down, that is the time you buy cheap and you sell high. And that buy well, renovate well, you can sell. So even if you can, there's an adjustment in the market, you've still got the headroom, the wiggle room to be able to trade out a position. And we have definitely seen our customers, as a result of the cost of living crisis, the shortage of materials. Remember the ship that was stuck in the Suez Canal? Remember that China was shut down. People couldn't get supplies, and we had to help our customers through that and navigate through it. With all those customers did well.
One big, certainly what I'm feeling a lot at the moment, the one big issue that we're starting to see is it's the lack of talent in the trade. It's the lack of people. That has really started. Does cause a concern to me and customers as well. Certainly when we've got, I think we've completed a few loans today, so maybe there's less than 1.5 million homes still to build. We're trying to play our part in by mobilising SME developers, but that labour shortage will catch up with us at some point.
It will. It will. You're right. And if we think about want to build 1.5 million homes, so you then start to say, well, where will the land come from to build those homes? Well, the land actually is there. They've got to give the planning consent. So they're going to recruit 300 planning new planners to go and give the consents. But like any job, you've got to learn it over time. You can't just say, right, I'm a planner, here's a tick in it. You've got to learn and understand what's really going on. But it doesn't work like that. It's a bit like when we recruit an underwriter. You can't give them a £5 million mandate on day one.
Correct.
You've got to build them up over time. and let them grow through experience, and also making mistakes as well. So we do a load of planners, which is great. So let's say that they can deliver the starting things off more quickly. We can get rid of the so-called pig in the pipe.
Yeah.
You then got to get the materials. You then got to find the labour. Now, labour has been more difficult to come across, as you quite rightly said. It's become more difficult to come across, particularly because of Brexit.
Yeah, but we've also got a burning issue. A large majority of skilled tradespeople are over 50.
That's an interesting point. Just expand on that a little bit.
So with them being over 50, manual job, if the average retiring age of a tradesperson is 63, and we're not getting that generation of new talent coming in, I think we were talking to a guy over lunch the other day, and he made a really interesting comment. There are 5 universities in the UK that do a degree-style course in hairdressing. He runs a glazing company in Fascist. There's not one that does anything in this field. So there is anybody who's going to university are not going to be in his
apprenticeship, the old-fashioned apprenticeship, where you become a carpenter, you become a plumber, and those are the skills that are in massive short supply at the moment. Not everybody should be going to university to learn to be, a manager. Some people have actually got better skills with their hands, and they should be pushed in that direction. They certainly will come out with the debts that young people are coming out with now from university.
As always, we find ourselves just going slightly off topic, so sorry about that. I felt like we were just in the car on one of our trips then. But I think if we just move to the next slide, what is interesting, we're talking a lot about investments.
Yeah.
But we have got a lot of property investors on this who signed up for this. And again, thank you very much for giving us your time. One of the things is it's about that due diligence piece. We mentioned underwriting. So let's walk through that process. You've got your site.
Yeah.
You've got your planning.
Yeah.
You've got your materials.
Yeah.
You've got your labour.
Signed off the conditions.
Yeah. The big thing you need now is cash.
Yeah.
And cash is that's the thing that's going to. And when you're looking for where to source that cash from, it's important that you're picking the right partner to go with.
Absolutely.
On a lender, so I always quite passionate about this again. A lender is your biggest or your majority business partner to get that scheme done.
Yeah, if that lender is funding 75% of the costs, they are your majority business partner. And therefore, the relationship that you build with them, the relationship that they build with you, effectively, it is almost like a joint venture.
Yeah.
I know it's debt, obviously, but it's a joint venture between you and the lender, because you're both incentivized to seek a positive outcome at the end, which is either a property that will rent or a property that will sell.
Yeah. Absolutely. And I think when you're doing that, you've got to find the right business partner. We'll always do our due diligence, and we'll talk about that in a moment. But what kind of things should people be looking for in a lender? Or lending partner? Let's talk about lending partner.
Okay, so let's look at lending partner. So the first thing that's important is, where does their money come from? Okay, and there's an abundance of lenders. Okay, a lot of them don't have any money. They say that they're lenders, but they don't have money. So let's think about, where could their money come from? It can come from peer-to-peer. It can come from high net worths. It can come from institutions. It can come from institutions. It can come from family offices. It can be their own cash sometimes. But everybody, even if it's their own cash or family office, everyone's got a limited pot of cash.
Yeah.
Okay. And everyone's driven by sales. So from a customer's perspective, the worst that can happen to them, and we've seen that at the moment with one particular lender that I can name, which I won't, where the lender doesn't have the money to support their customers. And when you are doing a development, you've got to pay your subbies on a Friday. You've got to pay for your materials. And if you become cash starved, how do you complete that project successfully? And so choosing understanding where a lender gets their money from can often, from your perspective as a developer, be the difference between being able to complete a project successfully and unsuccessfully.
Yeah.
So, the first question is, and by the way, there is no nirvana. So if you look back 15, 16 years ago, a number of banks went bust.
Yeah.
They had some serious challenges.
Yeah.
So just saying, I'm going to a bank, that's not always nirvana. You've got to try to work with people, with lenders that get their money from multiple sources. So the more sources they get their money from, the more different types of sources, the better, because the risk of them running out of money whilst you're doing your project materially reduces if they've got diversified funding pools. So don't be afraid to ask those questions. We know that our money, we've got our own money, we've got family office, we've got some high net worth, we've got 2 banks in the syndicate, we've got Building Society, we've got Greater Manchester Pension Fund, part of Manchester Authority, British Business Bank. We've got a whole load of different funding sources, because it's our view that a chair with 10 legs is far more stable than a chair with 1. So if I was a customer, knowing what I know, I would not be afraid to ask the question of the lender, where do you get your cash from? And a lender that says, none of your business, I'd say, well, you know what? I don't want to be part of your business either.
It's that transparency piece.
Transparency.
You're going into business together.
Yeah.
I think it's also making, it's the reference point. A lot of, if you've got customers or people who are using them, normally property professionals network with other property professionals. Have them conversations.
Absolutely.
And we know that we've got to work hard to give good outcomes and good relationships, because they're essentially your customers sell your business.
Of course you do.
They either sell it or they drive it away.
They are your best net promoters.
Yeah.
Absolutely. So nothing wrong with saying to a lender, can you give me the details of 2 or 3 customers in my area that I can reference you as a funding partner with? And why should they have anything to hide? Obviously, from a GDPR perspective, they've got to go and ask the existing customers, are they happy to be referenced? But if I think about our customers, they'd be more than happy to talk to new partners.
Yeah, and the same goes for brokers as well.
Look at the kind of networking that we do. We actually bring our customers, in the room at the same time, so that they can learn from each other.
Yeah, you've got to add value to everybody's business.
Yeah.
So, and obviously with it being predominantly bridging and development finance, it's a time-bound finance piece. It's your best friend because it can complete quickly. It can put you in liquidity quickly. But it's your worst enemy if you run out of time. And if your lender are causing the time to run out with delays in drawdowns, with delays in the internal processes, if they cause in them delays, then obviously it slowly dissolves your profits opportunity.
So there's 2 things there to look at from what you just said. The first one is understanding the lender's, because it is a lender, the lender's legal process. So by way of example, we know that almost 10 years ago now, we completely reinvented the entire legal process. We found when we started in business that if we instructed 4 different lawyers on the same loan for the same customer on the same property, there would be 4 different processes that the different lawyers would follow. So we said, this is no good. The tail cannot wag the dog. It has to be us as the lender dictating to the lawyers the path that we want them to follow. And so that's what we did. We made it very prescriptive. And we will give a customer a copy of the questions that our lawyer was asking the borrower's lawyer that they can answer. And they're simple questions. And then the whole of the rest of the transaction is insured. And we simplify that. And so our customers got confidence working with us that the legal process won't, or certainly shouldn't, be a barrier to completion. That's the first one. And the second piece that you mentioned is the drawdown process, which is understanding what's involved in getting the further advances to fund the project. And if I think about the way that we've done it within Roma, we've got a team. They are incentivized as a drawdown team to get money out the door. That they are an enabler, they're not a blocker, because we want to, once a customer's doing a project, we want to be on site helping them, signing things off to get them the cash in their bank so they can pay their subbies and pay for the materials and move on with that project.
100%. I think as well, when you're thinking about when you're looking at that lender, you're looking at reviews, you're looking at all these things. Can you speak to them? That's the big thing. Can you speak to them? Because in the world, we haven't got time to even go into AI on this. I'm sure you bring somebody better than I on for the AI discussion. But in a world where technology is advancing at a rate of not, the ability to speak to a human and be listened to and explain and have an opportunity to chew the fat about an outcome that is mutually beneficial is worth its weight in gold.
There is nothing worse than phoning a company and getting a bot or online getting a bot to deal with.
They can't understand my accent. Honestly,
is that the Scouse?
And the more angry I get, the more Scouse I get. So
it's true. Human being, humans, people buy from people.
Yeah, definitely. And what obviously, all lenders, it feels like if there are barriers to go through when you because it's a large sum of money. A lender needs to see if you're a good custodian of their cash.
Absolutely.
Our approach to it has always been borrower. So understand who the borrower is.
Yeah.
What's their expertise? What's the background?
Yeah.
And then the story. What are they looking to do? That's the big thing. What are they looking to do and why?
Yeah.
Have they done it before? Is this an opportunity? Is this within their wheelhouse? Have they got the right people around them to help them get there? And then look at the asset. Because again, I think we could play bingo today with our favourite phrases, but I'm certainly a big believer. A good borrower can create value out of any asset. A bad borrower can destroy value in a good asset.
Yeah.
Back to what I said right at the beginning, this is a partnership. So if we're going to give the cash, we want to see a positive outcome.
Yeah.
We want to see a positive outcome. We want you to enjoy yourself and go back around again.
Yeah.
So borrower, story, asset, and then the big one is the exit.
Yeah.
You touched on this earlier, which is about sometimes I know we could be twice the size we are
Easily.
if we were riskier on LTVs and LTGDV. 100% we could, because people will take it, but they won't be able to get off the loans when the speed bump happens.
Yeah.
So having the ability to navigate between different exit strategies in that liquid market, so making sure actually they can be rented, so you can go to a rental exit.
Contingencies.
Using our Roma Pro range, we sell our buy-to-lets in there.
Yeah.
You can sell some, keep some. You were going to rent them out. Actually, the cost of funds have gone up. You're going to sell them because it's a liquid. Having the ability to give yourself, and sometimes that little bit more time, or the ability for us to give a little bit more cash.
Yeah.
That's the key, because that's almost in 12 months' time, after we give you the first slug of money, 12 months' time, we need to be able to do something again if we can.
So repeating that back to you. So borrower, story, asset, exit.
Yeah.
Understanding the borrower, make sure they stack. Then understanding the story, make sure that makes sense. Okay. And if the asset doesn't stack up, okay, then typically that borrower with that story is doing something to that asset to add value to that asset, which means they can get the exit.
Yeah.
So understanding the transaction, lifting the bonnet on what's going on is the key way in which we can effectively, that's how we underwrite. Borrower, story, asset, exit.
They will be buying the worst house on the best street.
Yeah.
And you've got to back the right person to make it the best house on the best street.
So if they do something to that asset to make it from a bad asset to a good asset, they'll be able to get the exit. Yeah. And that's why we do it.
Yeah. Just move on to the next slide for us, please. We're not trusted with the clicker, you see. Otherwise, we'd still be on the first slide, I've noticed. So I think here there's just some information that's coming to show that actually it's not just your viewpoint, which is obviously a really strong and approved right for the business and our growth strategy. But those green shoots are there if you do look for them.
Yeah, absolutely.
When we are seeing some customers who have gone from building multiple years, they're not going to go commercial.
Yeah.
And again, in that high street piece, if they're doing the commercial and maybe a bit of residential above, there's two income streams. Maybe they sell the flat to keep the shop, put the shop in the pension fund. There's loads of different opportunities. It's not all just about creation of a new home ground up, is it?
No, it's not. There are so many opportunities. I love, for me, seeing our customers creating wealth for themselves and their families is incredibly rewarding. It is. Because we're helping them on their property journey, and whether it be, and we know what a Roma customer looks like, whether that be the blue collar on the tools carpenter that's going from project to project to project, or whether that be the doctor, dentist, lawyer, pilot, surgeon type who's looking to create some passive income through property. All of those customers need looking after, and it's incredibly rewarding seeing them be successful on the projects that we're helping to fund.
Yeah, we've got two roles to play really. One is to protect the business, so we're good custodians of our funding line cash. And then the next one is to give the customer as good a time as we can.
Yeah.
At least as that partnership.
Yeah.
So then they come back around again. They prove to be a good custodian of our cash.
Yeah.
They create that wealth.
Yeah.
They have that crystallization event.
Yeah.
And they would like to go again.
Yeah.
And they can do that themselves. They can come back around with the broker, or the broker brings more people to us. We are comfortable operating in both spaces.
I think it's very interesting. I think that there's a really interesting point here that you've raised, which is
there's been a few.
There's one really interesting point you've raised. which is that, there's lots of talk about lenders acting responsibly.
Yeah.
Okay, and absolutely, the lender's got a duty of care to offer the right product to the right customer in the right way for the right project. Absolutely, but I think there's also responsible broking as well, and it is the broker, the customer, the lender, the outcome, they should all be aligned. Because if the broker puts the customer with the right lender for the right project, and the customer has a good experience, the lender will want to lend to them again, the broker will want to advise again, the customer will want the broker to advise them again, and everybody wins.
We called it, I was out with a broker actually yesterday on site in Manchester, over there. And we were on site, and the broker was there and the customer. And we used the phrase open relationship. We've got an open relationship, which is there'll be times when we'll only speak.
Don't say that to my wife, you might get.
Thanks for stumping me there. But certainly, there'll be times when we'll want to speak to the customer because it's quicker, it's faster, it's more efficient. And so we'll pick the phone up and speak to the customer. There'll be times when actually we need to speak to the broker to go back to the customer because we need to navigate something that's coming through. And there's a time when all three of us can get together and talk it through and bring in experienced professionals like the right lawyers in, the right QSs in, which is invaluable really because that is all about having open communication. Just flick to the next slide, please.
She's asleep.
I know, I think I whispered it. Sorry, just there we go. So a couple of things that we talked about here, but again, there was on the Roma Talks podcast, which you can also get on YouTube if you want. If you'd rather see me be the host instead of the guest. We had Finbar from Procurement for House Builds, and he said something really, really good. When it comes to getting the right financial solution or picking your team or whatever it is, you stick to what you're good at. If you're not good at it, get somebody else to do it.
Yeah.
So if you are really good at building, but you're not really good at engaging with a lender, or if you're not really good at procuring materials, absolutely get somebody who can, because it will make your project go on time or as close to on time, as close to on budget, and a lot more enjoyable. Surround yourself with the right people.
I think that you just raised something which I think is a good lesson in business generally. I remember one of the lessons that I learned in the early days of Roma, because I used to be the cook and the bottle washer, and did everything in between as well, and including all of the covenant compliance with the funding. I'd do all the reporting myself, and it used to take hours to do this stuff. And make sure it was 100% right. Anyway, guy came in, new recruits, and he said, I said, do you fancy doing this with me? And so I showed him what we were doing. And then next time I said, you do it yourself. He did it seconds. He put it all into Excel, into a pivot table, and he got and just the answer straight away. And that for me was a realization that there are people who are better at their jobs than I am. That there are people that can do it better. And so delegation is not abdication. I still sign them off. I still look at them to make sure that we're trading properly and what have you. But there are people that are better at their jobs than I am at theirs. And I think that it's just a lesson in business generally, that going back to what you were saying, if you've got to be honest about what your skill set is, and if dealing with the finance is not your skill set, but being a fantastic carpenter is, or being whatever, stick to what you're good at and bring the knowledge in around you to help you deliver something.
Absolutely. I think there's never been a better time to be having a go at property, because there is a lot more people out there to help. Certainly, and the networking that goes on, flex that network, flex the connections, ask people where they utilities is a big thing as well.
Massive problem.
All these bits. There's a lot of shared pain out there, but there's a lot of shared results. And I think using the right finance is one, making sure that you're picking the right product for what you're looking to achieve, how long that you need that funds for. It's not just about the rate, it's the usage, how long, the fees.
How does the lender behave when the chips are down? If one question to ask a lender is, what did they do during COVID? Not that long ago. There was an unexpected except missile that came from the side, to knock everybody off their feet. Okay, some lenders use that as an opportunity to make extra margin. Other lenders saw an opportunity to support their customers and help them to trade through. And I think that, again, going back to due diligence that you do on a lender, understanding what that lender did during COVID, which was a time of extreme stress, will help answer an awful lot of questions. And for one, I'm proud of what we did in the way in which we supported our customers through that very difficult time.
No, absolutely. But I think as well, there was customers who went through that who are still customers now.
Absolutely.
And in short-term lending, it's a very big hamster wheel. Now that we've got, we've relaunched Roma Pro, our term loan, which enables people to stay with us for longer.
Yeah.
But if people are with you typically 12, 18 months, it's a big hamster wheel. The more customers who come round that circle with us again, we know, like, and trust each other. That borrower and story piece just gets wider and wider. If we just move to the next slide, because I think there's one key thing you wanted to get across, which is you wanted to lead people to the 5 key takeaways.
Yeah. I think that the first one, so the 5 things to remember if you are a property investor, a property trader, a property developer. Number 1, if you buy well, you can sell well. Key to all business, buying well. So the process of buying and procurement is more important than the sales process, because if you buy well, even if things come to knock you off course, actually you should still be able to sell well. Okay, number 1. Number 2, choosing the right finance provider, the right lender, is very, very important for the right project, and making sure that let me just go back a second. I beg your pardon. There's something wrong with that slide. So number 1 is buy well, sell well. Number 2, making sure that you are creating a product that is right for the market that you are going into. So we've talked about the example of a granite kitchen in a terraced house in Boston. Okay, a melamine work surface in a footballer's house in Alderley Edge, by way of example. So making sure that the product is right for the climate that you're looking to go into, whether it's a rental property or a sales one. Third one, do your due diligence on who you choose to partner with, which lender you choose to partner with. Ask the right questions, get references, speak to people, and visit the customers that they've got around you. Don't be afraid to ask those questions. You have every right to ask those questions. Number 4, volatility creates opportunity. Don't be scared to be brave, because the time, it's a bit like what Warren Buffett says, which is be greedy when others are fearful, be fearful when others are greedy. And we've seen that a few years ago, everybody was into property. Okay, great time to sell. Okay, time to buy is when everybody's scared to be in property. And the last one is related to the second point, which is that make sure that the product that you are creating is going into a liquid market that is right for your customers. If it's a rental property, don't overspend. If it is a high-end residential property, make sure the right kitchen, the right bathrooms, because it's kitchens and bathrooms to sell properties.
But also make sure it's in an area with other high-end properties.
Absolutely.
If it's a rental, there's no point doing a rental in a rural area where it's all homeowners. And you've got to make sure that the market that you're putting into is liquid as well.
Yeah, absolutely.
I don't know why I jumped in there.
No, it's fine. It's absolutely fine. Thank you for aiding that conversation.
No worries. Just move on to the next slide, because you do have another one coming up, don't you?
Yeah, so the next webinar that we've got is on Monday the 14th of April lunchtime, and it's really around technology and how will technology enhance property finance, property trading, the property market generally. And there's a huge amount of work that's going on with property technology and investments at the moment, and we'll cover that in a few weeks' time on Monday the 14th of April.
Instead of myself, it'll be Chris Friendly.
Yeah, and he's a great he's got a business which is really growing and thriving, and I'm excited for him to join us.
No, definitely, and we're proud supporters of that as well.
Yeah, we are indeed.
And obviously that brings us towards the end or to the close, but you have got any questions, or if you'd like to reach out to myself.
We've got some, I think it's got 6 questions.
Have we?
Yeah, should we take a look at those questions now?
Yeah, absolutely.
How do we access those questions?
That's where I'm going to tap out your technology ones next week.
Look, it's just the 2 of us. Oh, here we go.
I think some of them are quite in depth. We'll take them offline, I think.
Yeah, I think so.
In depth. So what we'll do is we'll take them offline and probably circle back to the individuals who's put it on. But if you do want to get in touch with ourselves at Roma to talk about the product range that we have, or even ask us some of those questions about lender due diligence, absolutely contact us. Reach out to myself if you want to on LinkedIn
or myself on LinkedIn.
Yeah.
There's nearly 70 people that work in the business, and everybody is here to help your dreams come true.
Excellent. Thank you very much for your time, everyone. I think that brings us to an end.
Thank you for joining us.
Cheers.
Bye for now.